This is Coach Mark Justice, and it is my honor to bring you the next video in the Decoding Buffett series, where we're going to discuss the art of valuation. Now, when you're starting the valuation process, you need to look beyond the numbers. You can't look at just one number alone without comparing that number against industry standards or the historical performance. That one number might lead to some misleading conclusions. For example, if you only look at a PE ratio, that number isolated from all other numbers might not tell you the correct story. If I only look at a low PE ratio today and don't take into account future growth and what the future PE is telling me, well, I might be missing a declining future earnings story. If I just look at a PE ratio and don't compare it to other PE ratios within that industry, I am not getting the correct story told to me. We have to look beyond the number because a number is just a number without the proper context. So we've been talking about how a number is just a number without the proper context. At Tackle Trading, we view this through the price versus value lens. When consumers enter the marketplace and start learning how to invest for the first time, they just see a price. 10, 20, 30, 50, $100. They might think $100 is more expensive than $10 because that's the only context they have for the price. But remember, that's just the price. As Buffett famously said, the price is what you pay. Value is what you receive. We must focus on value. So our entire job is to associate what the value of that price is. For example, investor A, who follows the Decoding Buffett series with the Tackle Trading community, prioritizes their education because they know that with the right knowledge, they can stay in this game for a very long time. They focus on understanding the value component. Meanwhile, investor B, who is also new to investing but lacks further education, only focuses on the price itself. Therefore, it's our job to determine the value of that price, not just the price alone. And the only way to assess the true value of a company is to look under the hood at the fundamental metrics. So let's start a little fundamental comparison between two companies and two types of investors. On one hand, we have investor A, and they are looking at Academy Sports. On the other hand, we have investor B, and they're looking at Planet Fitness. Both of these stocks in the consumer discretionary space. Now, investor A, who's watching the Decoding Buffett series, sees the $60 price tag, and they know, well, that's $60, but I'm going to have to dive under the hood to see if that $60 represents value. Whereas investor B, also new to investing, sees that $60, but that's all they see. They don't have any context to put that under. Well, it is going to be our job to put context, put valuation to that price tag. And we're going to dive into some metrics in order to help us do that. We've been discussing the differences between price and value. Consider investor A, who focuses on the value component of price, and in contrast, investor B, who merely anchors against the price. But what's aiding investor A in grasping the valuation aspects of price? It's what we refer to as financial ratios or fundamental analysis. These financial ratios include the PE ratio, the price to book ratio, the PEG ratio, and the free cash flow ratio. Say it with me one time. Ratio, ratio, ratio. Lots of ratios everywhere. But what do these ratios accomplish? First, they reveal the context around price. Second, they help us standardize comparisons among similar companies, allowing us to compare two retail companies against one another, two technology companies, or two energy companies, rather than just looking at one single company in isolation. Remember, when you only look at one company or one number, it doesn't provide the proper context. These ratios, therefore, are invaluable tools in our toolbox to help us understand the valuation component of price. So ratio. Well, let's look at one of the more popular ratios, the PE ratio. The PE ratio compares company's stock price to its earnings per share. Now, lower PEs might indicate undervalued stock, where higher PEs might indicate overvaluation. Remember, a number is just a number, and a PE ratio is exactly that, a number. So we need the right context to compare the PE ratio against. Benjamin Graham, when he wrote The Intelligent Investor, stated that a PE ratio over 20 is considered overvalued and under 20 is undervalued. Traditionally, we use that 20 figure as a benchmark for comparing overvalued versus undervalued scenarios. However, we must also consider that the market in 2024 is different from when Benjamin Graham originally published his seminal book 75 years ago. At Tackle Trading, we approach the analysis of PE ratios by considering primarily two things. First, we look at the sector and industry. For example, if a stock has a PE ratio of 15, but the sector's average is 22, then it's likely undervalued relative to its industry according to the Benjamin Graham guidelines. The second aspect is the overall market cycle and the prevailing PE ratios for the market. It's not merely because the stock has a PE ratio of 15, but because this figure falls below those of the industry, sector, and market as a whole. Thus, a number is just a number, and this principle applies to every concept in fundamental metrics, including the PE ratio. We evaluate it in context with the sector, the industry, and the overall market. Now, there are two types of PE ratios. There is the traditional trailing PE ratio that most investors are most commonly used to, and there is the forward PE ratio that takes into account future growth expectations. So let's come back to our fundamental comparison of the two stocks and the two types of investors that we were using earlier. Now remember, we have investor A, been watching Decoding Buffett, applying fundamental metrics, and we got investor B, who just going off price itself. Well, we've just, in the last few slides, went over a few fundamental valuation metrics. Let's apply them here to this case study. Well, when we look at the metrics out there, we see that the price to earnings of Academy Sports is 8.8 versus Planet Fitness, which is 37.5. And we see that the forward PE ratio on both of the companies comes down when accounting for growth, but Academy Sports is 7.8 versus north of 21 for Planet Fitness. Now we're starting to make a little bit of a case, and investor A, who's watching the Decoding Buffett series, is seeing, all right, I have some context, I have some ratios. And when I look at the price to earnings here, I see Academy Sports, a very healthy 8.8, whereas Planet Fitness has a 37, which indicates it would take 37 years to pay back the price of the stock based on earnings alone. A little bit of case is made. As we're applying these ratios, getting context to just the purchase price itself. Well, let's throw another ratio into the mix and learn a little bit about the PEG ratio, because we've been looking at just valuation PE numbers, but we want to take into account growth as well. We want to try to identify undervalued stocks that also have strong growth potential. And this is what the PEG ratio, or the price to earnings growth, does for us. It helps us identify high growth but undervalued stocks, and has a pretty simple metric baseline where a below 1.0 number could signify potential undervaluation. Another ratio that can help us build a case for margin of safety. Now remember, that's what we're trying to anchor against here, is margin of safety for a company that can give us that buffer zone when we make an investment. Well, price to book ratio can help us do that by measuring a company's current market valuation against its book value. Now 3.0 is a standard ratio that numbers below that may attract value investors. All right, let's get back to our fundamental comparison where we've been using these two investors, one looking at ASO stock that's been watching the Decoding Buffett series, and one that's been just anchored against purchase price using Planet Fitness, who doesn't have this information below. Well, we've added in the price to earnings and 4P ratio in this comparison and making a case. Investor A looking at ASO is like, all right, this is a decent case. But we want to add in some growth. It's not just about valuation. We want to look at growth as well. And when we add in the PEG ratio of ASO, we see it comes in at 0.63, a healthy number. Remember, below 1 indicates that might have an undervalued situation going on. So that continues to make a strong case for ASO. Whereas we look at Planet Fitness and we don't see a PEG ratio number. One might ask, well, what does that mean? That means under the current valuation, under the current numbers we have, there's no growth anticipated to be able to calculate into this number, which can be a little bit of a warning sign. Now let's talk about free cash flow, or FCF. This is the cash that a company has left over after it covers the outlay necessary to keep the business running and well maintained. It's what's left after we account for the cash outflows needed for operations and to maintain or grow the asset base. What does positive free cash flow tell us? It's a sign a company has the financial health not just to survive, but to thrive. They can use this extra cash for growth initiatives, paying down debt, or distributing dividends to shareholders. And firms with strong free cash flow, they're in a position to fund new projects on their own, fueling steady and sustainable growth. Consider this quote from Charlie Munger. Without cash flow, it's hard to have confidence in future earnings. Without confidence in future earnings, it's hard to value a company. This underscores the importance of free cash flow as a key indicator of a company's financial flexibility and future potential. Remember, free cash flow reflects a company's ability to generate cash and reveals much about its financial health and strategy. Now let's dive into the price to free cash flow ratio. This measure gives us a snapshot of how a company's market price stacks up against the cash it actually puts in the bank after all the bills are paid. It's about seeing the real value investors get for each dollar of cash flow a company generates. Consider a lower price to free cash flow ratio. This could be a signal that the stock is a bargain, giving investors more bang for their bucks in terms of cash flow. It's a tool for those with a keen eye for value, seeking to capitalize on stocks that might be undervalued by the market. And why do investors keep an eye on this ratio? It's straightforward. Companies that show efficiency in generating cash tend to be healthier and offer more stable investment prospects. So the price to free cash flow ratio doesn't just stand alone. It works alongside other valuation tools, sharpening the focus on how effectively a company turns its operations into cash profit. For investors hunting for firms with robust cash flows priced just right, this ratio can be a beacon, guiding them beyond mere earnings or book value to the efficiency of cash generation itself. Now let's talk dividends, one of my favorite subjects to talk about. Dividends are more than just a slice of a company's earnings. They're a distribution of the profits to the shareholders. This is a tangible reward for their investment and trust. This form of direct profit sharing has its own set of advantages. Unlike capital gains, which rely on stock price appreciation, dividends provide a return on investment that remains independent of the current market price fluctuations. They offer stability, a steady income stream that can bolster an investor's confidence during the market's unpredictable ebb and flow. Furthermore, the sustainability of dividends can often reflect the underlying financial health of a business. A company that consistently pays out dividends may be signaling its robust cash flow and profit generation, essential indicators for a company's long-term viability. In the realm of investment potential, the dividend yield can be particularly telling. A higher yield might suggest that a company is currently undervalued or that it is committed to returning a substantial share of its profits to its investors. For those seeking attractive income potential, a strong dividend yield can be a lighthouse guiding their investment decisions. As for investors who weigh their options in a sea of comparable stocks, dividends can tip the scales. In situations where investment choices stand neck to neck with one another, remember this: dividends often break the tie. They represent not just a share in profits for you, the investor, but a share in stability and a stake in the company's ongoing success. In conclusion, dividends can play a pivotal role in building a resilient investment portfolio, particularly for those who value consistent income alongside potential capital appreciation. It's clear why dividends are considered by many to be a vital piece of the investment puzzle. Throughout this video, we have been doing this fundamental comparison between two stocks and two types of investors. We have investor A, who's been watching Decoding Buffett, who has been learning about fundamental analysis, and we got investor B, who just looks at price. Now, we've ran through different metrics. Now let's look at, now that we've added a few more, what the numbers tell us, what the numbers tell us to do, because that's really what fundamental analysis is all about. We went through the purchase price, which is about the same. But then as we started applying things, price to earnings, forward PE, PEG ratio, we saw that there was a significant fundamental case for ASO compared to Planet Fitness. Now, when we add in price to free cash flow, we see that that fundamental case strengthens even more. The numbers doing the talking. And then if there was a tiebreaker, which the numbers tell us there isn't, well, a little bit of a dividend yield wouldn't be too bad of a little bonus along the way. That wraps up this video in the Decoding Buffett series. Don't forget to like, share, and subscribe. And thank you so much for being the best part of tackle trading.